So we're into a new year, and that means we have another tax season right around the corner. So April 15th, 2026, that's when your 2025 individual tax returns are due. In this video, we're going to talk through some of the big changes that happened with the One Big Beautiful Bill Act, how some just inflation adjustments are going to impact your 2025 tax filings, and specifically what individual taxpayers living outside the US need to know about their 2025 tax filings this year. So the first thing I want to talk about is the inflation adjustment parts of this. So if you're an expat living outside the US and you take the Foreign Earned Income Exclusion, that number gets adjusted up for inflation every year. So in 2024, your excludable amount was $126,500. For 2025, we get a boost to $130,000. So that's your maximum Foreign Earned Income Exclusion for your 2025 tax year is $130,000. Similarly, there's other things that the IRS adjusts for inflation, such as your standard deduction. So married filing jointly, this got a big boost. This goes up to over $30,000 this year, whereas it was like $26,000 in 2024. And it's different depending on your filing status. But we got about a 2 to 3% bump on the standard deduction for 2025. Similarly for the child tax credit. So in 24, there's a $2,000 child tax credit per qualifying individual. This year it's $2,200, with the refundable piece being $1,700. So that means that if you have no tax liability at all and you have a qualifying child eligible for the child tax credit, you can get a refund. The IRS will actually pay you up to $1,700. Whereas if you owe tax to the IRS and you have a qualifying child, the creditable amount to reduce the tax amount is $2,200. And in addition to that increase in the standard deduction, there's now this new qualifying seniors standard deduction. So there's an additional $6,000 if you're filing single, or $12,000 if you're filing jointly, that you can get if you're over 65 years old. So that's on top of the standard deduction that you're already eligible for. Now there is a phase out for that. So once you hit a certain amount of income, that additional boost goes away. But it's worth considering. And if you're doing some projections for your taxes coming up, that's something to factor in, is that additional standard deduction. So that's more on the inflationary side of things. There's a few more that I want to mention that are very new for this specific tax year and related to the One Big Beautiful Bill Act. The first thing that was probably the most controversial within Congress and the things they fought about and have been fighting about for the last several years is the SALT cap deduction. So if you live in a high tax state, or a tax state at all really, you'll know that part of the Tax Cuts and Jobs Act back in 2017 was to reduce your ability to deduct your state taxes on your federal tax return. That got capped at $10,000. So there's a lot of taxpayers that pay more than $10,000 of state taxes that no longer could deduct it against their federal tax beyond the $10,000. That was one of the big battles in Congress with coming up with this One Big Beautiful Bill Act. And what they settled on was a $40,000 SALT cap. So again, it's not all the way back to the unlimited deductible amount for state taxes, but now it's capped at $40,000, which obviously makes a huge difference. That's an additional $30,000 of taxes that people in these high tax states can take advantage of. Another interesting one, which is very specific to the Trump administration, is this car interest deduction. So in the past, there's been an itemized deduction for mortgage interest. So any interest that's secured by a loan on a home. So that could be home equity interest or mortgage interest, and that goes on Schedule A. And remember that your itemized deductions and standard deductions, you're allowed to take the higher of the two during the year. So a lot of times if your itemized deductions, one of which is your mortgage interest deduction, is not higher than your standard, you take the standard deduction. This is different with this new car interest deduction, where it says that passenger vehicles now can deduct up to $10,000 of interest on their vehicle loan. And it's not an itemized deduction, so it's going to be deductible directly against your income, even if you take the standard deduction. So that's a pretty good deal, as in the past, that was always considered a personal interest amount and not deductible, similar to a home interest is deductible now, except we don't have to put that as an itemized deduction. You can take the standard deduction and still itemize it. Now, again, there's a phase out for that. It looks like we're still learning some rules on this, honestly, and we have to see how the IRS comes out with their forms and how they pull all this together into the filing itself. But there's going to be a phase out, and it looks like at $100,000 or $150,000 of income, you're going to start phasing out of the ability to utilize this new car interest deduction. But definitely something to look out for. If your accountant's not asking you your car interest during the year, that's something you need to provide them to make sure it's being calculated correctly. And the last piece I want to talk about is no tax on tips. So I'm sure if you watched any news over the last year, especially in the run-up to Trump's election in 2024, there was a big campaign around no tax on tips. And so what ultimately happened with that is that there's now no tax on tips up to $25,000. So if you earn tips up to $25,000, you can exclude that from your tax. Now, we're still waiting to see exactly how the forms shake out and how that looks. But one thing I wanted to mention for expats in particular, and really self-employed people, is how we may be able to utilize these new rules to get a little bit more tax benefit. So somebody that maybe is taking the foreign earned income exclusion, but earns a little bit extra on top of that, maybe we can use this tip deduction to drop down another $25,000 as not taxable. For example, in the self-employed context, what's not going to work is just if you receive income from your services, you can't just in your own work papers move $25,000 of that income over to tips and reduce it. You have to be clearly paid, and the expectation between you and the person paying you is that this amount was for tips versus this other amount was for the services you're providing as your hourly wage or whatever it may be. So if you're receiving a tip for your services, what's going to be important is that when you bill your services, you need to make sure, for example, if you're using Stripe or something like that, there's an option to allow for a tip. So you need to make sure that whoever's paying you, and the way you send that out is they pay you through the tip section, and as opposed to just invoicing for the work you did normally, because that's not going to be enough for you to be able to classify it as a tip. It needs to be paid and intended to be a tip by the person paying you, obviously. For example, like as an accountant like me, I generally don't get tips for the work that I'm doing. So it's even more important in that case that if it is understood that what I received was a tip and it's going to be non-taxable, I need to bill it that way. So the bill is not going to include that fee. There's going to be a tip that comes through separately, which you can do through all the major payment platforms. But obviously, if you're in an industry where you're receiving tips, likely you're going to be tracking that separately from your normal income because you're going to get paid differently through those tips. But that's a big change this year, as having a $25,000 removed from your taxable income. Like all things, there's a phase out for that as well. So once you get over a certain amount of income, of total income, they're going to start phasing out your ability to use that deduction on tips. So these are just some few quick things that are going to help you prepare for your tax return filing that's coming up. Some additional deductions, some changes to last year's filings that maybe you weren't aware of. So make sure you're taking these things into account as you plan for your 2025 taxes. If you have questions on your 2025 taxes, feel free to reach out to us at McGowanTax.com, and we can help you make sure that you're paying the least amount of taxes and doing things correctly.